Hello, I'm Preston Brewer, and I'm a legal analyst with Bloomberg Law. I am very pleased to be joined by Emily Oldshue today to talk about private equity, evolving deal terms, and exits. Emily Oldshue is a transactional partner in the Boston office of Ropes Gray. Her practice consists of a mix of mergers and acquisitions, including SPACs, capital markets, and private equity. Emily represents a diverse base of public and private companies, investment banks, and private equity funds. Typical deals include representing public and private acquirers, sellers, and targets in domestic and cross-border M&A and private equity transactions. Emily was recently profiled by the Boston Business Journal as one of the winners of their 40 Under 40 contest. The profile discussed how Emily's practice centers on the intersection of private and public companies and how she has built a niche law practice advising publicly traded firms on disclosures to investors. Emily graduated Phi Beta Kappa from Wellesley College and obtained her law degree from Yale Law School. So I'm really looking forward to our discussion today. I think it's going to be great. The focus of our discussion will be primarily about SPACs in relation to private equity. And, SPACs, they, as IPOs, they boomed last year up until the first quarter of this year. And then now there are a tremendous number of SPACs looking to de-SPAC, which means they're looking for a reverse merger deal with the target corporation. So Emily, what are your thoughts? I want to move the slide. What are your thoughts about the current landscape and the trends lines when it comes to SPAC exits for private equity-backed companies?
Yeah, sure, Preston, and great to be here with you. So picking up on some of what Andy touched on in his remarks earlier, I do think that SPACs will continue to be an alternative, and in some cases the right alternative for exit opportunities. There is just so much activity, and as you say, there are just so many SPACs right now chasing deals that it would be hard to deny their place in the market in chasing some of these M&A opportunities. I suppose just to set the stage here a bit, looking at it from the other perspective, 30% of the companies sold to SPACs during the recent boom were private equity backed. So certainly it's a significant component or a significant percentage of SPAC deals that do have that as a component. And then looked at from the vantage point that you set up, it's just a huge amount of capital chasing deals and competing for deals. So if all of the currently live SPACs, the SPACs that have IPO'd, were to consummate transactions within their investment horizon of 2 years, and at the multiples that we tend to see on average in SPAC deals, which is roughly 4.5 times the IPO proceeds, that's $800 billion in M&A deal value in the next 2 years. And so while I think most people would agree that perhaps not all of these SPACs are going to find their eventual suitors, in any event, it is a large amount of capital chasing deals and competing for opportunities.
Okay, great. There have been a lot of discussion in the market about SPACs and their benefits. What is the typical profile of a portfolio company for which private equity owners might pursue a SPAC exit?
Right. So I would agree with Andy that it tends not to be the first choice, right? So if there's an attractive M&A suitor, be that a private equity secondary or a strategic, or if a traditional IPO is a possibility given market conditions and given the particular company, I think those tend to be the first choice, right? But in certain instances, you do see private equity firms and the operating companies looking to pursue a SPAC transaction, or at least to consider it and see what pressure they can put, upward pressure that is on valuation by talking to SPACs. A couple of situations in which you see them considered more so than in passing, right, is market conditions, as Andy mentioned, can challenge an IPO, and so a SPAC in some instances can be attractive for that reason. Sector comps in particular industries, and then this so-called more complicated story element, right? So if you've got a lot of recent M&A or projected M&A, there's an opportunity to give more context to the story by way of including projections and pro forma financials in the investor presentations in connection with a SPAC deal. Additionally, at times it depends, exactly which SPAC deal we're talking about and where the market is at a given moment. But there's oftentimes a bit more of an opportunity to gain near-term liquidity than in connection with an IPO, at least historically speaking. And then there's an ability too to quote unquote save a deal on the back end if needed, because you've set a proposed valuation in advance and then gone to the market. And if the market shifts between when you've announced your deal and when you close your deal, there's a bit of time, more so than there is in connection with an IPO pricing, to go find additional financing or renegotiate the valuation and shore up the deal. So those are some of the situations in which we see SPACs play a more prominent role as companies consider their alternatives.
Emily, you mentioned on your slide that the valuations have softened a bit due to a tightening in the pipes market. Do you have any thoughts on why that might be so?
Yeah, I mean, look, we because of the amazing boom in IPOs that you referenced, there just wasn't an opportunity for capital to recycle and come out of all of those IPOs in time to be reinvested in the pipes. And so while there was, for a time, plenty of capital to go around and people were able to double down in the pipes, I think the expectation is, right, that once some of these de-SPACs close and some of the capital is recycled, there'll be more of an opportunity to raise capital more easily in the pipe market again. And then I suppose it would be fair to say too, right, that there's just the boom itself softened, right? So SPACs were super hot, and the market itself has just tightened a bit, and the pipe market has tightened alongside that, right? So you're seeing fewer IPOs, and the de-SPACs stalled out for a couple of reasons a few months ago, due to some SEC guidance and some of the other commentary and market reactions to the space. So I think it's a combination of factors, and one which presumably may loosen once we see some of the capital recycled through the de-SPAC transactions closing.
That makes perfect sense to me. I mean, I've been hearing plenty about, there's been constraints in the SPAC pipeline, about insurance and just people at the SEC needing to review it, and other professionals all the way down the line. So, that makes sense about recycling, the money. I'm going to move to the next slide. So what process items are areas of focus for private equity investors pursuing a SPAC exit for a portfolio company?
Yeah, I guess a couple of thoughts on this point. So where private equity-backed companies are committing any significant effort to pursuing a potential de-SPAC transaction, as opposed to just sort of considering it alongside the more attractive exit opportunities, you tend to see what's being referred to as a SPAC off, where the banker involved in concert with management and with the other advisors puts together a term sheet and sends that out, similar to what you would see in an auction process. Sometimes you'll see the combination agreement sent out as well. And the goal there, right, is to distinguish among the SPACs and create competitive tension such that you're able to extract the highest amount of valuation you can, and also other favorable terms, some of which we'll touch on in a moment, around dilution investing and potential earnouts to gain more upside in the valuation. So you'll see a process with 10 or 15 SPACs competing against each other to be selected as the winning SPAC to pursue a de-SPAC transaction. A couple of other things from a process perspective that we're seeing of late, due to what we were just talking about in the pipe market tightening and where some of the SPAC deals have traded after announcement and concerns about valuations being too high and so forth. One of the trends we're seeing is that people are less willing to commit legal and other resources to a deal before there's some credibility in terms of the indications of interest from pipe investors. And so we're seeing that process more front-loaded than we used to, trying to get out to talk, whether just to a few potential anchor investors or to a broader set of investors, to make sure that the pipe market, or at least be more sure rather than less sure, that the pipe market is going to support the valuation that's proposed in the deal. And I guess a final point I would mention on this score is analyst coverage, and that's by no means unique to private equity-backed companies as a concern, but it is one that you see considered in SPAC deals, because whereas analyst coverage sort of evolves more organically in connection with an underwritten IPO, that's something that takes more attention in a SPAC deal, and is something that people do work hard to earn along the way, and generate interest along the way, such that they have adequate coverage once the deal goes live.
Okay, great. So I want to move on now to deal terms. I think deal terms are something a lot of people care quite a bit about. And Emily, are you able to discuss some of the key terms that private equity owners focus on when they're working with portfolio companies to pursue a public listing by way of a de-SPAC?
Yeah, for sure. So the first term, which they would share in common with anyone pursuing a de-SPAC transaction, right, is consideration and the overall valuation. A couple of components there that I think we've hit in passing, but I can mention again. Our negotiation, in addition to the headline valuation, right, around the vesting and forfeiture of the sponsor promote, that's something that reduces dilution and aligns the sponsor with the existing investors and with the PIPE investors. And then additionally, and this is one of the reasons that SPAC deals can be attractive, is that there's an ability to include an earnout component where the target, where the operating company shareholders would be entitled to receive more shares if certain share price thresholds are achieved following closing of the transaction. So those are some key areas of negotiation and focus. Price discovery with the PIPE market, as we discussed, is another key area of focus in that regard. And then, as is always the case with private equity investors, liquidity is a key area of focus. So making sure there's careful attention to having registered shares, particularly given some of the constraints around 144 in SPAC deals, is something that's a key area of focus. Shorter lockups, right? So that's something that we've been seeing in the IPO market more generally for some time now, and is certainly something that you see in the SPAC space. So while there is ordinarily a lockup on the target shareholders, there's a lot of pressure to keep it as short as possible. Focus on redemptions.
So how long are you typically seeing at this point? What like, you know, if they're shortening it, how long are the lockups that you're seeing typically?
Yeah, right. So if the base case is 6 months in a traditional IPO, and we've been seeing pressure for that to come down more recently, which of course we have, in SPAC deals, it is a bit all over the place. And in some deals, you see no seller lockup that has some considerations for the trading right at closing. And I think most people have gotten some religion that at least some lockup is appropriate. But you do sometimes see 3 months. You sometimes see 4. You see 4 months, but with early release, right? So you're able to craft a more bespoke arrangement than you sometimes see in traditional IPOs, or I suppose you could craft it in the IPOs, but you see it more in SPAC deals, that there's bespoke arrangements around the lockup and the release rights as it relates to the lockup.
Okay, very interesting.
I'm
sorry to have interrupted you.
Sorry, not at all.
Go ahead.
So redemptions are a key area of focus, and they're, I suppose, just to step back here, as you of course know, Preston, these the redemptions are something that you track along the way once you've announced the deal, and are of course trying to keep to a minimum. But they unfortunately are not something you have a complete sightline on until two days prior to closing. And so that continues to be a wild card throughout the process, which people seek to solve for in various ways. And one of the ways, and one of the things you see pressed in deals, and I would venture even more so of late, is seeking non-redemption agreements, such that you're able to ensure that some of the registered shares on the back end will still be in the market and available for trading, such that you don't end up with an illiquid stock or an overly illiquid stock once you close. And so having those non-redemption agreements is another area of focus as people consider their liquidity.
For people who don't know, I just wanted to quickly explain, that redemptions are, the availability, with SPACs for someone who doesn't like the merger deal to be able to get the money back, but that's based on the company's original offer price in their IPO, so they can get that level of money back if they don't like the deal. So that can sometimes
Exactly,
throw a monkey wrench into things if too many people want their money back. If too many people investors redeem their shares, there's not much time, and then they're left scrambling to try to fix the deal and work things out.
Yeah, that's right. And initially people were solving for that with ever larger pipes, which were thought to validate the valuation and provide assurances to the existing public shareholder base. One of the things you started to see as the market shifted was that the redemptions crept ever higher, and they certainly have been quite high in recent deals. And one of the considerations around that, when you consider that so many people involved in the transaction are locked up on the back end, and that the pipe shares are unregistered, of course, is that you can have liquidity concerns on the back end, and you have a really thinly traded stock if you have really high redemptions, because the lion's share of the liquid securities, the tradable securities, are then have been redeemed out, and so you can end up in a bit of a tough spot, even if you've raised a lot of capital in your pipe. Like even if you've raised enough capital to run your business and achieve your strategic objectives in the near term, just the illiquidity issue can be an area of focus.
Okay, we've got just a couple minutes left, so do you have anything particular to talk about governance rights and deal costs before we talk about the litigation?
No, I don't. I mean, people have the slides, and I think it's pretty self-explanatory. I'd call out that especially in the current environment, it's ever so helpful to have your pipe very firmly locked up, and you'll want to make sure that the closing conditions there are very tight, and that if your underlying deal closes, the pipes don't have an opportunity to walk away, because of course the scenario there is that if people are redeeming, it means they think the stock will not trade at above $10 upon closing, and the pipe investors, being similarly situated, having committed to buying in at $10, would ordinarily be looking for an opportunity to not spend $10 on a share that the market thinks is worth less by the time they're buying it. And so having those closing conditions nice and tight is something. And then I suppose in passing, I'll just mention two more points, which is that the structure, you can deploy any number of alternatives here, same as you can in an IPO, to achieve tax and other objectives such as regulatory objectives. And then on deal costs, we're starting to see a trend there to being quite mindful of the cash burn on deal costs in SPAC transactions.
That's always an important consideration for sure.
Yeah.
There's been a lot of focus on recent SEC enforcement activity and shareholder litigation in SPAC transactions. Emily, can you give a bit of context there and discuss how your private equity clients are thinking about those elements?
Yeah, for sure, and I'll compress the discussion here, just mindful of the time. Right. So the recent SEC enforcement action that you're referring to, Preston, gave people a fair bit of anxiety, because the situation that evolved was one in which the SPAC sponsor was actually named in the enforcement action alongside the CEO and the SPAC, and then on the target side, the CEO was named as well. And some of what was said in that enforcement action gave people pause, right? Because it was a criticism of the diligence process, and it was a criticism that went beyond, you didn't run down red flags. I mean, what was said is that they were lied to, more or less. And so obviously a pretty aggressive posture to have taken to think that the process, to have called out that the process was insufficient, when indeed there were a number of advisors retained who did look at what they considered to be the key issues. The board took advice from those advisors, and so I think a lot of people reacted because it was out of step with some of the prior enforcement actions and the level of egregiousness that you would need to have seen to be subject to such an action. So that certainly gave people pause, and it has implications for the M&A process. The net of which is, at least if we're talking about Delaware, the considerations are the same. That if you've got conflicts, and of course SPAC transactions inherently have more of those than an average deal just due to the SPAC structure. Consideration of special committees and fairness opinions in certain instances, and then disclosure, right? Being very careful that not only have the conflicts been disclosed fully to the board and dealt with appropriately from a process perspective, but also that they're fully disclosed in the disclosure materials. So I think the conflicts are a key area of focus, right? And then there's some other ancillaries around the accounting for warrants and so forth that drew attention to SPACs yet again. But the key area has been on conflict and diligence and public company readiness. And so I think perhaps I'll leave it there just given our time today. But it is a focus on the key elements of disclosure and public company readiness, same as you would see in an IPO.
Well, Emily, I really appreciate your participation today in our webinar. It's been wonderfully informative, and we really appreciate it. Thank you very much.
Excited to do it. Thanks for having me.